Hello, it's great to have you joining me for our very first show of 2014 as we head into our 7th year of Your Money, Your Call here on the Business Channel. I'm Margaret Lomas, and tonight we're talking all things property and of course answering all of your questions too. But first to the news, and the outlook for home values in 2014 is positive, with last year's figures showing a 9.8% increase over the 12 months to December. The RP Data Rismark results show that across Australia's capital cities, there was a 1.4% rise in December and a 2.8% rise in dwelling values over the final quarter. Cameron Kusher of RP Data says the results, the fastest annual rate of value growth since August 2010 and the largest calendar year increase in values since 2009, when home values were up by 13.7%. However, Kusher was quick to point out that the increase was not overly significant when considering the long-term data. And cashback incentives, interest rate discounts and fee waivers are among the multitude of mortgage incentives flooding the market. Industry experts say the mortgage industry is at its most competitive level since the global financial crisis, and Australians should expect to see many more attractive mortgage deals pop up this year to attract new business. 1300 Home Loan Managing Director John Calenda said he expected increased competition in the mortgage market, particularly for those looking to refinance. Now, if you've tuned in this evening, the reason we're here is to be able to answer any question that you have about property. And to help me do just that, I've asked Ben Kingsley from Empower Wealth and Paul Rickard from Switzer to join me in the studio. And so if you have a question for us, don't wait. Call us right now on 1300 30 34 35 or email your question to me now at property@skynews.com.au. Welcome back to both of you.
Thank you.
And Happy New Year as well.
Thank you, Margaret. Great to be here.
So we're heading into the new year with plenty of enthusiasm for the property market. Fabulous figures out, but of course, as we all know, figures historically don't really mean a lot. What everyone wants to know, and what I'd like to know, is what you both think about what's going to happen in 2014. Paul, what do you think is going to happen in 2014?
Look, I think we're sort of through the first year of a sort of a 3-year bull market, maybe a little bit longer. So typically these market cycles, I think, are about 3 years. And I think our data shows that at about November, October 2012 it is now, the market started to fire up a little bit. So I think we've got another sort of 12 to 18 months to go.
Okay.
So I'll be looking for some more increases in 2014.
Now, of course, the thing that worries me a little bit about when people do say that we're looking for the market to do this, we have thousands of markets in Australia, and someone could be sitting out there in Udnadatta thinking, okay, Paul said the market's going to do really well, I'm going to go and buy that property next door that I've always wanted to buy. And frankly, I'm not picking Udnadatta as a place to invest this year.
That's not surprising, Margaret.
What do you say to that?
Well, I think you're absolutely right. I mean, people have to be aware of the property market, of course, is, you know, a million different markets. And, of course, all these figures we look at are just the averages of on some reasonably small data.
Yes, exactly.
So when I say, you know, we had, well, the data says 9% last year overall, I mean, that's looking at, you know, a data on a small number of transactions. So I think people need to be really careful, need to think about the area, and as you always say, look at what the prospects are for that individual suburb and then, of course, that individual house or unit.
Absolutely. Ben, you know, to what extent can we use all of these figures that fly about the place that are typically historical figures? To what extent can we really trust them and use them to work out where to invest next?
Generally, Margaret, I'm a big believer in values. I think that's an important indicator of longer-term outlook. But the big stuff for me is really around the income and the demographics. So they're the key drivers for growth generally in a marketplace. So if income's growing, then affordability or borrowing power is there, and that allows the marketplace to find its new value. So as long as you've got that pent-up supply and that stronger demand, I am a big believer that if you can find areas that have shown some reasonable historical performance and understand what those drivers were, in other words, if it was professionally led by strong incomes, then that's a good growth story for, say, an inner suburban area. For a regional town, it's more around the infrastructure and what the economic activity that's happening out there that's going to attract a new population out to that particular market, and then having a look at, you know, what that means in terms of, again, linking that back to the income and then linking that back to borrowing power to see whether there's some uplift in value.
One of the things, Paul, that worries me through times like we're seeing in Sydney and potentially Brisbane and Melbourne will follow suit throughout 2014 is that what the buyer frenzy tends to do to people is it tends to make them look at a market like Sydney and go, oh my goodness, I've got to race in and get something really quickly and it doesn't matter where I buy, and they become a bit indiscriminate. Yep. And the next thing that happens is they're following everyone else in. You've got the big crashing herd coming through, and a good 50% of people who have taken part in that will probably buy over market value and find that they're going to lose some money next year.
Well, I suppose a couple of things. One, you need to be patient. It's like any investment. You're in there for the long term. Define what you mean by the long term. I think you'll be very careful because you can see it in the media every Saturday night. If you watch, sometimes I'm at home, maybe I don't have enough social activities, but if you watch the 6 o'clock news on a Saturday night, you know, second or third story in is going to be about the auction results, and you're starting to see that same sort of frenzy you talked about.
Yeah.
And of course, look, there are always people buying at auction, there are always things turning over, and the question is what's happening to what's all about the property that you're looking at, the area, and what it's going to do for that.
Yeah.
So I do think you need to take a reality check, and you do need to be patient and get the right advice and think about what's going to drive prices of that particular property or area up, and they're going to be different depending where you're looking.
Yeah, good advice. And we'll come back and I'd like to continue that discussion because I think there's plenty of stuff we can talk to the viewers about tonight there. But let's go to the phones. And Mel, you're from South Australia. Welcome to the program.
Thank you, Margaret.
What can we do for you, Mel?
Yeah, I'd just like to know, you know how Holden is closing in Elizabeth?
Yes, I do.
At the moment, there's like a lot of bad rap about that.
Mm-hmm.
Now, what would that do to property prices if there's going to be a lot of unemployment in the area?
Okay, look, it's a really good question, and I remember, I'm old enough to remember when these same questions were being asked about Newcastle with the closure of the BHP plant. And of course, there was no blip even on the radar. Ben, how do you feel about the closure of the Holden plant in Elizabeth?
Mel, great question. One of the important things we need to understand is property is an emotional transaction for most of the buyers. So what you are going to see is there may be a sentiment movement, and that could be just a little bit of apprehension in this particular market. But as Margaret was saying, longer term, you're going to see that potentially as a buying opportunity. So if you believe in the long-term story of what's happening in that community and what's taking place in terms of what the council want to do and the uplift that's generally taking place, this could be a buying opportunity for those brave enough to get into that type of market. But it's a sentiment story for now, and once that sentiment and confidence returns, I think you'll see, you know, medium to longer term, it's going to be all right.
Do you concur with that?
Look, I do. I think the Newcastle example is really interesting. In fact, Newcastle's done really well, and so you haven't even seen any, you know, when BHP closed steelmaking in Newcastle many years ago, you know, 10 years down the track, it hasn't really even registered. Perhaps I'm not as positive about Elizabeth, but I think it really depends upon the plans for alternative employment and industry inside that suburb. So I'd probably I think it's going to take some while. So if I was a seller, a keen seller, I'd be a little bit worried. And as Ben says, maybe the buyers, they pay to wait and there might be some good bargains. But I'd be a little bit concerned. It sounds like, Mel, that you might be from there about thinking about Elizabeth.
You know, I think it's all a bit of a storm in a teacup, really, because you think about Elizabeth, we're not talking a regional area where nothing exists there except this Holden plant. We're talking about a standard everyday suburb of a greater capital city which has 1 million people. It is roughly 20-25 minutes drive on a good day, maybe 40 minutes drive on a really bad day from the CBD to Elizabeth. It is a simple suburb of Adelaide that has that new northern freeway linking it directly back into the CBD and also up through into the Barossa Valley. And if we think that everybody who lives in Elizabeth works in the Holden plant, then we're thinking incorrectly, because they don't. In fact, there's a lot of people who are in many different kinds of employment up there in Elizabeth, and I think if you did a count, you'd find that a very small portion of them actually work in that Holden plant. Elizabeth does not exist for the Holden plant. It exists because it is an area with affordable housing, with not much new land, but plenty of infrastructure, and a council who's very, very committed to making sure that their employment situation is well in hand. And I think because of that, we shouldn't be worrying so much about this Holden plant closure. I think maybe, as Ben has pointed out, and as Paul has pointed out, there could be a bit of a short-term sentiment or emotional impact on property in Elizabeth. Then after that, everyone's going to just forget there ever was a Holden plant there, and we'll move on, and the property should be absolutely fine from there on in. It's also a great place to buy something that is really good value right now as well. Thanks for tuning in. Now, don't forget that every Monday night, the panel and I choose one question from either the emails or the calls, and we send a copy of one of my books. And this week, the best email will receive my latest book, How to Achieve Property Success, which is a great all-round guide to buying an investment property. Later on in the show, I think we'll have a picture of that book for you to have a look at. If you call us now on 1300 30 34 35 or email there it is, property@skynews.com.au with a question, and make sure you watch at the end of the show to see if you're the lucky person to get that book. Now, we're off for a short break. Don't go away. When we come back, we'll take some more calls and answer your questions. Welcome back. Joining me tonight is Ben Kingsley from Empower Wealth and Paul Rickard from Switzer, and we'd love to answer your questions if you have one. Call us now on 1300 30 34 35, or you can, of course, email us on property@skynews.com.au. Pauline, you're from Melbourne. How are you doing?
Good, thanks, Margaret.
You've got a question about foreclosures.
Yes, I'm currently looking at a property in a regional town in Victoria.
Okay.
It was on the market for 4.5 months. Started off at 310, got down to offers over 215. It's only 8 months old. It's a 4-bedroom, 2-bathroom. It's very nice. I've had a look at it.
Yes.
Now, when I went down, the agent told me that it has now gone to the bank.
Yes.
Only just gone to the bank. I've put a written offer in. Now, I spoke to my lawyer today, and he said usually these properties, the bank will take them to auction because legally they're bound to get the best price for the vendor. But he said, seeing as it's been on the market for 4.5 months, they may take your offer. Now, what I want to know is if it does go to auction, can you give me any tips on how I conduct myself? And any risks that I need to be aware of with this type of property.
Okay, now, Pauline, can you tell me where it is?
It's in Morwell.
Okay. Okay, Ben, let's go to you first, and maybe Pauline's basic questions about, what can she do with this foreclosed property?
Look, Pauline, thanks for the call. It's an interesting situation. Obviously the window of opportunity may have closed. So if we're going to go to auction, one of the interesting things, if it's the same agent who's going to auction the property, they're going to know your offer. So one of the things you need to try and work out then is it wise that you actually represent yourself at the auction, or will you put someone else in place who's going to do the bidding on your behalf? Because if that real estate agent's going to see you there and the price point isn't going to get to the actual level that you're willing to make an offer on, you want to be in a position to secure that property at the best value you can. So one of the things you may want to consider is bringing in a specialist, a buyer's agent who's qualified to do that type of work, or bringing in a family member or someone who's had experience in that particular activity of bidding at auctions on your behalf. In the Victorian marketplace, you don't have to register as a bidder. You can turn up on the day and do that type of thing, and you can be around the corner. So it's one of those tricky ones, but that would be one of the strategies I'd consider, especially if you're showing your hand to that particular agent.
That's a fabulous idea, Ben. I wish I'd thought of that and could claim that great idea. Paul, what do you suggest?
I find that very hard to add to. I think you've obviously done your research, Pauline, and I think Ben's advice is well worth thinking about.
Absolutely. You know, Pauline, the reason I asked you also where it was because I wanted to make sure that you weren't falling into the trap of thinking that it was going to be a fabulous buy because it had been 300, had come down to around the 200 mark. And very often people buy on a price point thinking, yay, I can get hold of this property and it's nice and cheap and it used to be 300,000, but all along it's situated in an area where you're never going to get any growth, you might struggle to get a tenant, and it's a property that even at half the price it wouldn't have been a good buy. I don't think there's anything really wrong with Morwell. I know that a lot of people are worried about the coal industry out there, but in reality, as Melbourne continues to sprawl out east, out west and up north, we're going to start to see areas like Morwell become part of the greater Melbourne area, and you are going to see some value, albeit it may be still a little medium term. I think Ben's idea is a fabulous one. Put someone else into that auction to bid on your behalf, but just make sure that they're bidding on your behalf, because that way, if they end up being the top bidder and it gets called in or it gets passed in, then the bidding or the offer goes to you. And so you're able then to be the one who, until you say, no, I don't want to do any more with this, then it goes to you. Just make sure that you had a good look at recent sales in the area. You're very familiar with the sales data. You think 215 sounds like a fabulous price because it was listed at 300, but is it? Is it equivalent to what recent properties have sold for? Not what they're on the market for, what they've sold for. Make sure that even at 215 that you're in the market for the right price and for market value, and that you don't end up with a property that you paid too much for. Michelle, you're from Berry. Welcome to the program.
Oh, thank you. Abbotsbury.
Abbotsbury, okay.
Yeah.
I was going to say, where is Berry? That sounds like an area that I've never heard of, but Abbotsbury I do know. And you want to invest in Wagga?
Yes, I was looking at Wagga Wagga, for example, Glenfield Park, and the homes are very affordable with good rent, but the same question, do you think in long term there'll be growth?
Okay.
And also another question, I'm 51, is it too late to start investing till I retire? Because, you know, I own my home, and I was wondering if I've left it too late.
Well, I think it's never too late, but do either of you two gentlemen want to comment on Wagga?
I was going to comment on, is it too late to invest? It's never too late to invest. So at 51, you've still got some time before you can access your super. I still think there's lots of opportunity, and in fact, many people in their 60s and 70s are still investors. So it's never too late to invest. Just make sure, of course, that you can, you know, you've got the cash flow to support the interest and any other costs you're going to have on the loan and in managing the property. So that's the main issue about investing. I think in terms of Wagga, I'm a bit mixed on Wagga. I think a lot depends on some of the outlook for some of the military and other areas that support the Wagga community, but I just don't know that particular suburb well enough to comment.
Do you, Ben?
No, I'm not big on those particular suburbs in the Wagga region. I will say generally around Wagga, it's obviously been a good harvest. Things are good in some of those regional communities. I just spent Christmas up on the Murray River, so I do know that area. Some frost was taken in some of the areas, but overall it's been a good time in that particular market. So, you know, one of the things that Margaret always talks about is, diversified economy. So Wagga has that. It has a stable base. It has an population base that's strong enough and good diversified employment opportunities. So if you get the right opportunity and the right buy, it's worth considering.
You know, I think Wagga is going to be much more long-term. It had a lot of investor interest around about 6 years ago, which kind of pushed the prices up a little over what I thought was market value at the time. And so while you won't lose in Wagga, I just feel that at 51, for you, what you need to be able to do fairly quickly is get growth. I don't know what your income is like. I don't know about your capacity to support cash flow. But to me, the most important thing for you at this phase in your life, and no, it isn't too late at 51, is to be able to get property that will grow sooner rather than later, because it's the growth that will enable you to leverage into more property. There's probably not a lot of point in buying one property. That won't do much for you in retirement, but if you can put together a nice portfolio, albeit a small one, it doesn't have to be a massive portfolio, then you're going to reach retirement with a good base that will then continue to grow into retirement. So your net worth at at retirement will be less than your net worth 10 years past retirement. If I were you, I would look around for a similar price range, and there's plenty of them, but in some of those outlying suburbs, the far outlying suburbs of some of our smaller capital cities like Brisbane and Adelaide, because I think you'll get a better opportunity for growth sooner in those markets for the same buy-in prices you can get in Wagga at the moment. Well, it's time to take another break, but if you do have a question for us, call us on 1300 30 34 35 or email property@skynews.com.au with a question. Make sure you watch at the end of the show to see if we choose you to get a copy of my book. We'll be right back. Welcome back to Your Money, Your Call. This evening, Ben Kingsley from Empower Wealth and Paul Rickard from Switzer is with me and helping me to answer your questions. So call us now on 1300 30 34 35 to join the queue, or you can email us on property@skynews.com.au. Now, Glenn is really keen to know more about super funds and property, so as I have Paul on the show tonight, I thought we'd read his email, and he says, if I buy an investment property through super, can I refinance this property and use the equity to buy another investment property in the future? And that's from Glenn. You know, Paul, this is one of the bugbears I have about people using super funds.
So we probably should answer the question first and say the bad news, Glenn, is you can't. There are two reasons. One is because you're using what's called... Super funds aren't allowed to borrow. The only exception is what's called a limited recourse borrowing arrangement. And the rules are very strict. And the two rules that count against this are, first of all, you can only have one loan for one title, so it's got to be a single acquirable asset. And secondly, once the bank takes, well, you take a custodian takes on the security, it can't be recharged to anybody else. So if you have a property inside your super fund, you can't use that to finance another property. However, if you do want to borrow to take another property, it's just your lender will look at the value of that property and the cash flow, and providing you've got some positive cash flow in your super fund, you know, that cash may account and give you some scope to allow you to take on a second property. But per se, you can't refinance one to get hold into another.
Which, of course, the bottom line of that means that if you get a fabulous property that grows hugely in your super fund, then you can't leverage against the growing equity.
That's right.
The only way you can get a deposit is to save it again in super.
That's right. And of course, if money keeps on going into your super fund and the cash flow from the asset is positive, which it should be, then that'll help you when you're coming to show to the bank that you can afford the interest costs on another property. But it's one of the downfalls of why, Margaret, I know you don't really like...
Yeah. Look, I'm not against them at all, and I bought property in my self-managed super fund, but property only represents about 30% of my super fund assets for starters. So I'm still diversified across the fund.
And then some would argue that 30% is too high. So
well, some would argue.
The property shows, so we won't go there.
And then considering my personal risk profile, then possibly not. But the point is, most people only have around 100,000 in super, which means one property. And then they put all of it into one property, and here we have a single asset. And to me, it's against the spirit of what the superannuation fund laws are all about. Personally, I don't see how they're doing it. I think it's a shifty, Ben, don't you?
Oh, look, Margaret, you know I'm a little bit pro self-managed super funds. I have one myself. So, look, there are some pros and cons with investing in a self-managed super fund, but we're answering the question, and that was, can you refinance? And the answer to that is no.
No, can't. Okay, we could have this debate for a long time, couldn't we? Because I do like them, don't get me wrong.
Look,
I like them.
There's some good
them.
reasons why a self-managed super fund and property makes sense, but
Yes.
the key risks you talk about is if the fund is there to provide for your retirement. So if you have a huge proportion of your fund in one single asset, you're taking a lot of risk,
Yes.
and it's risk you need to be able to manage.
Absolutely. This is Your Money, Your Call, and we're about to take a break, but when we return, you'll have another chance to get hold of a copy of my most recent book, How to Achieve Property Success, simply by calling right now on 1300 30 34 35 or emailing us on property@skynews.com.au. Thanks for joining me tonight. I'm Margaret Lomas, and with me is property person Ben Kingsley from Empower Wealth and Paul Rickard from Switzer. Now, if you have a question, call us right now on 1300 30 34 35 or email us on property@skynews.com.au. Helen, I'm glad you're here
Margaret.
from Wollongong.
Thank you for taking my call.
You're welcome.
Look, my husband and I are looking at purchasing an investment property at Salt Beach, which is about 5 minutes south of Kingsley on the New South Wales North Coast.
Yes.
It's in a large complex managed by either Mantra or Peppers. The purchase prices at the moment are quite low because they took quite a hit during the GFC and haven't recovered as yet. The rental returns are quite good, but the fees, being in such a large complex, are quite high. I was just wondering what the panel thought about the potential for capital growth in the area.
Yes, and of course, capital growth in Kingscliff is one thing, but then capital growth in a serviced apartment in Kingscliff is a different thing altogether, Ben.
Totally. Serviced apartments, Helen, look, statistics show us that we may get some really nice cash flows, and there's some terrific depreciation componentry to these types of investments, and having professional managing teams coming in under big brands also helps. But the reality is that this particular development has suffered not because of the GFC, it's suffered because there's been no demand for that type of accommodation in that area. So I'm with Margaret in terms of serviced apartments. They just simply do not deliver long-term capital growth. They have excellent cash flow returns early on, but if you're buying and investing, you need to invest for both growth and yield at the same time. So for me, it's a no-go.
No matter where it is.
No matter where it is.
Paul, new investors, inexperienced investors, people buying their first, second, sometimes third property are often very attracted to these developments because on paper they look like a fabulous business.
They do.
But unfortunately the overlying economy is their enemy, and it is a second layer of risk over the top of the fact that you're taking a risk by investing in property in the first place.
Well, it is, and there are enough horror stories around to suggest to Helen that you really should do your research and look at some of the horror stories, and then think, well, are you prepared for that? So, the fees can be pretty high, and you've got to look at what the prospects are for growth in that particular area. So I'm a bit like Ben. Once bitten, twice shy. I'd look very, very carefully, and by all means, pay and get a second opinion. Get an agent or a local property person to help you, at least guide you in this decision-making process.
And look, I've seen the horror stories first up, Helen, and serviced apartments are a different beast altogether from a normal, everyday apartment. It's all very well to say Peppers is managing at the moment, but you've seen it. They change hands, and, as quickly as people change their underwear. 1 minute it's Peppers, and then it'll be Oaks, and then it'll be Siebel, and then it'll be someone else, and every time there's a new raft of fees that come out. And at the end of the day, the people who are making the money are the people who are running the business, and very often that doesn't filter through to the owners. They can be very difficult to resell, and there's the problem. You don't have a lot of people moving in that market who are willing to embrace that kind of a risk, so the secondary sales can be difficult, and very often the complex isn't the kind of complex that can easily just be turned in to a standard residential apartment if everything else fails there. And even where they can be turned into standard residential apartments, very often you've paid more going in because they're usually priced for the expected return rather than for the true intrinsic value of that underlying security, which is an apartment in Kingscliff. I urge you to have a look and see whether the one you're looking at is an equal value to a standard everyday apartment at the same shape and size in Kingscliff. And if it is, then possibly, and if you can get out of that management agreement and independently rent out your apartment to an ordinary everyday tenant, then it might be worth taking the risk because at least you have a second end use. I think it's unlikely that they're going to let you do that, however, which means that you're right in there at the top of the risk chain buying a serviced apartment anywhere, let alone in Kingscliff. Brett from Deniliquin, welcome to the program.
Yes, thank you, Margaret. I'd just like to say thank you for your show. It's wonderful and very informative. We've learned a lot listening to you over the last year or two.
Well, thank you.
I've just got a question. We want to buy our first investment property, and we've been looking at Toowoomba. We're just a bit worried it's not too late to get in there, and if it's not, what parts should we be looking at?
It's a very good question. A lot of people have been buying up there in Toowoomba lately. Paul, are you all over the Toowoomba
Look,
market?
I'm not, Margaret, so maybe I should pass
Pastor Ben. Ben, are you all over the Toowoomba market?
We're not all over it, but we are definitely running the ruler over it, and it's an area that we've got on our high watch list, and we know that there's been some definite interest in this area, and there's been some commentators who have been making some good claims around the Toowoomba area. So one of the big things we worry about in these types of centres is who's actually driving the demand. If the demand is being driven totally by investors who are looking to get in because they're chasing the higher yields, then we'll step away, because the fundamental baseline valuations of where the market will settle is where there's owner-occupier support as well. So it might be nice in terms of it's the gateway to out to the Surat Basin and to all of the big developments and infrastructure and gas projects going on out that way. But the reality from our point of view is, has the market overpriced itself, and who's driving that demand? So if it's heavily led by investors, as Gladstone was for the last 12 months, and we've seen what's happened in Gladstone, you're going to potentially get burnt. So keep doing your research. It's certainly a watch area. I suggest there are opportunities in that market. I would be looking at median values or sub-median values, 25% below the median, as where I'd be starting. So you don't have what I call compression risk, which means that if the market does push itself too high, you're still down in that very, very strong affordability belt, which means that, you know, there won't be any damage control that we'll need to go into if we've mistimed the marketplace.
You know, it's interesting you talk about Gladstone, and we've seen what's happened in Gladstone, but I can tell you what's actually really happened in Gladstone, and there were two markets there. There was all of the new stuff that came through, and it was priced a good 200 to 250,000 over just your standard 3-4 bedroom resi market, which has actually fared pretty well throughout all of this. The big high ones that were coming in at 550 and 600,000 have dropped right back, but the ones that were only around 3 to 350 not only stayed where they were, but actually shifted up a little bit. And so it looks like there's this big fallout, but it's because of a lot of developers. It happened in Cairns as well many years ago. There was a big developer there building a lot of stuff. His marketing was so good, he was selling it at a good 50% over the true intrinsic value of these properties, all to southern states buyers who are out of Cairns. Now, he ended up going into liquidation, and it all fell over, and suddenly all of these people had property that looked like it had lost a lot of value, but it was because they paid too much in the first place. So as far as Toowoomba's concerned, I actually think investing in Toowoomba is a pretty good prospect. I don't think it's going to suddenly take off in the next year like some of the suburbs of some of our second, as I said earlier in the show, capital cities behind Melbourne and Sydney. So capital cities like Brisbane next, I believe, capital cities like Adelaide will have some of their suburbs take off. Toowoomba should come in fairly close behind there. We have to remember that the Toowoomba Council merged about 6 years or 7 years ago. It was the merger of 9 councils to make one super council, so they've got a lot of money for infrastructure, and they've got a pretty keen mayor up there who wants to see it happen. If I was going to buy in Toowoomba, there are two things I'd look for. First of all, I would look for property within the inner 5-kilometre ring, because it's too early to go to the outer suburbs of Toowoomba, and there's plenty of bargains to be had. But second of all, there's also quite a lot of large blocks, and I'd be looking for something that was potentially able to be redeveloped, because then what will happen is when everything starts happening in Toowoomba, you'll be left with the equivalent of land value on probably a big block that you can either build a second dwelling behind, or perhaps pull down and build 3 or 4 units, and that's when you're going to start to see some really good returns on your investment. So I think Toowoomba's all right. Maybe stick with it and look there, but don't be afraid to go into some of those suburbs that we also talked about. Thanks for being with us. We're off for a break, but when we return, you'll have another chance to ask your questions simply by calling us on 1300 30 34 35 or emailing us on property@skynews.com.au. Welcome back. I'm Margaret Lomas, and with me tonight on my expert panel and taking your calls is Ben Kingsley from Empower Wealth and poor Rickard from Switzer. So call us right now on 1300 30 34 35 or email us on property@skynews.com.au. And Rebecca, welcome to the program.
Hi, good evening, Margaret, and Happy New Year, and I love to watch your show.
Thank you.
Okay, my question is, last year, me and my partner, we bought the one-bedroom investment property in Homebush West, and which is doing well, and we are ready to buy the second one. And I've been told that Liverpool is the next one to buy, and I just want to get some opinion from you.
Who told you that, Rebecca?
Oh, it's just one of my friends. They said that to buy the one-bedroom apartment from Liverpool, it costs $380,000, and I get the good rent return as well.
And I wonder if your friend is a property investment expert.
I think he's involved with some property industry, but I don't know if he's an expert or not.
Okay. Well, let's put it to the panel for you, Rebecca, and see what they have to say. What do you think of Liverpool, Paul?
It's probably not the area I'd be looking at. I note the price, $380,000 by Sydney standards. That's in the affordable range, and there aren't too many even units in Sydney for $380,000. So, look, I'm just with some of the development earmarked for the southwest of Sydney, particularly some of the recent announcement by the New South Wales government about big land releases, plus what else is happening down in the southwest. It's probably not the place I'd be looking at in Sydney. I still think that even for that market, $380,000, you'll find better value in one-bedroom units in other parts of Sydney than Liverpool.
Okay, and what do you think, Ben?
Yeah, no, I'm not a fan, Rebecca, of the one-bedroom apartment out in Liverpool. I'll tell you why. If you look at the incomes in the Liverpool area, in terms of the changes in incomes, again, you heard me earlier tonight talking about, that drives borrowing power. At $380,000, if you actually do a bit of searching for some of the older stock in the Liverpool region, you can actually see houses, two-bedroom houses around that sort of 380 mark. So I wouldn't be attracted by the new flash stainless steel appliances or the European, appliances and those types of things. I'd be looking at the fundamentals. I don't mind Liverpool as a region, but I'd be buying as what I call a wave rider strategy, where I'd be buying those older style properties that are effectively at the entry level of where the affordability is, and I'd be measuring that against the income that you've got in that area, and you might see some better opportunity. But I'm a bit like Paul. It's not on my hot list at the moment.
It's not on my warm list either, Rebecca, and I think one of the things that's really crucial for you to understand on the back of everything that both Ben and Paul have said is that when we look at the future demographic shift in Liverpool, we're actually shifting back again more toward families who were there initially, and for a long time it hasn't been so much that family unit. Because the demographics is going to be centred mainly in families, then a one-bedroom unit simply isn't going to make the grade in Liverpool, and it's not the right kind of property. Now, it's interesting because for $380,000, there are some fabulous buys in other states in far more vibrant areas. But you're looking in Sydney because you live in Sydney. You already probably own your own home or are paying off your own home. You've got a property in Homebush. You're also then going to think about land tax, although depending on your own home, which is obviously land tax free, you've got a unit there, you're probably a little way off. But we do need to think about diversification, and I think you're going to get some really good buys in a really good mid-ring part of Brisbane for $380,000 in a great 3-bedroom, 2-bathroom house right in that demographic that pushes up prices, and as Ben says, have the kind of income that allows them to borrow at higher rates and push up the prices than you would buying in Liverpool. I also think you need to tell your friend thank you for the advice, but start listening to qualified property investment advisors and have a coffee with your friend and a good time instead. Now, Mark has a really quick question about interest rates, and he writes, "Hi there, a very common question. Should I fix partial, full fixing, or is variable the way to go?" Anybody game enough to actually...
Look, I'm always in the partially fixed category, mainly because of certainty. I think as an investor, it's the most important to know what your budget is, so that interest is a major cost. If you can fix it, you lock in the cost, you can plan around that, you know what your income from the rent is, you're much better off. In terms of where interest rates are heading, if I had to have a crystal ball, 12 months' time, interest rates will be higher than they are today. That's because of what's happening in the US and will lead our market. But like all of us in this business, sometimes we're right, sometimes we're wrong, and these things often take a lot longer than we expect. So that's why I sort of take out some of the risk, at least fix a fair component of it to, I just think when we see big figure fours in front of interest rates, that's an area that, for me, I say lock it in.
Ben, would you agree with that?
Yes, we're hedging for our clients at the moment, Margaret, and we're sort of hedging around that 50%. So we're not going fully fixed because of the inflexibility, and it stifles opportunity when we might want to sort of look at doing something else or our circumstances may change. But I'd be definitely looking at fixed rates at the moment. They're quite compelling. The bonds are pushing out, so we see fixed rates potentially moving higher. I'm a believer that the rates will remain steady, except if we see a property explosion, then we'll see rates go higher. But right now I don't think there's enough sort of macroeconomic stimulus that's happening to see that. But the RBA do not want to see price bubbles in the property market. That's what led to a GFC in the US. So for now, rates on hold for probably the next 12 months, but I'd be fixing a portion of that.
And look, I'm inclined to agree that maybe you should fix a little bit, although I wouldn't rush out and bust my baller to do it in a hurry. I'd sort of shop around a bit. I'd see whether or not there are some good fixed rates available in the next little while. Remember, if you are an investor and you're asking this question, don't forget that you're getting a bit of a cut on that interest rate through a deduction on your tax anyway. So every interest rate rise is only worth 70% of the rise to you, or up to 45% of the rise if you are on a higher income rate. So we're not quite as sensitive with interest rates when we are investing, and whatever interest rates are below that 5% mark, which is generally the average we're going to be getting as a return, then we're still ahead on the game. I wouldn't be rushing out to fix, but I'd also just keep my finger on the pulse a bit, and maybe, as the panel have said to you, think about fixing just a small amount of it, or maybe up to half of it, but certainly no more. You don't want to lose that flexibility. Thanks for tuning in. It's time for a break, but when we return, we'll of course answer more of your questions and answer some more email. To have yours answered, simply call us now on 1300 30 34 35 or email us on property@skynews.com.au. Welcome back. It's been a great night with my expert panel, Ben Kingsley from Empower Wealth and Paul Rickard from Switzer. Now, if you have a question, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Sue, you're interested in investing in the Blue Mountains, I believe.
Yes, Margaret, I am. Thank you for taking my call.
You're welcome. Now, where in particular would you like to buy?
It's in the lower mountains in a suburb called Warrimoo.
Okay. And why do you want to buy this so that when you retire you can go there?
It's a possibility, yes. Yes.
I had a feeling. What else have you found out about the area, and why do you think it would make a great investment?
Well, it's not too far from the station, probably the house, probably about 1 kilometre from the station. And I think that the Blue Mountains is probably a fairly good growth area, but that's what I wanted to ask you, actually, if it's worth investing there, and what would the growth be like?
Okay, let's go to Paul first. And what do you think, Paul?
Look, I'm reasonably positive about that suggestion. I think the lower Blue Mountains in particular probably have a little bit of a sentiment issue at the moment following the fires in October, November. You're right that there's no more land to be released up there. In terms of growth, it really depends on Sydney and people potentially looking either as a community area or potentially like yourself looking to downsize and retire for the lifestyle. So look, I'm not sure exactly what the market's done up there over the last 12 months, but my guess is it's probably showing some reasonable opportunities. And I think if you've done the research, and take your time, there's no need to rush into any of these markets. And I think particularly somewhere out of Sydney like that, I think you can take perhaps a little more time and really, study the market well and find the house that you're really looking for.
Ben.
Thanks for the call, Sue. Look, this is a story about population, and it's a story about jobs and access to those jobs. If you can't get quick access to an employment centre, then what's going to attract people to want to rent up in that particular marketplace? So I'm a bit sort of, I suppose, off the Blue Mountains area. It just doesn't seem to give me the diversity that I'm looking for in terms of attracting the type of renter that I'm looking at, and the fact that you're trying to juggle two balls in the air in terms of potentially moving there as a lifestyle choice later in life says to me that it's not really a pure investment. So for me, it's a no-go.
Look, I always worry about people who do want to get their purposes a little bit mixed up. And when it comes to investing in property, we invest in property purely for the purposes of providing for a good retirement plan and a retirement income, not so that we can have somewhere to retire to. And typically the best places to invest, they're rarely also the kinds of places that you'll aspire to go and live in. I see people all of the time who want to go and buy in places like the Sunshine Coast, they want to buy up in Hervey Bay, they want to buy in all of those beautiful destinations. And the reason they want to buy them, and the reason I asked you the question about whether or not you were thinking about this as retirement, is they want to buy it really for themselves, and they're using as a short-term excuse the fact that they think it will make a good investment. Very often those same people haven't done any kind of research into an area, and typically when you said to me, well, the house is quite near the station, that's normally the sum total of the research that people will do into buying a property as an investment. Now, if you step away from what you need as a retirement cottage and start to think about the fundamental growth drivers that we need in an area to make it worthwhile investing there and to make it better than just putting our money in a bank somewhere, they include things like a population growing faster than the national average, a median household income growing faster than inflation, also lots of infrastructure and service provision, and a highly diversified employment base with manufacturers and large employers being attracted to the area to provide ongoing employment. Now, if we think about those things, the lower Blue Mountains doesn't have any of that. It's a beautiful place to be, and it does have proximity back to the city, so it's not going to flatten or go backwards, and it will grow. But I believe investing there is an opportunity cost for not investing somewhere that will give you a better return and provide you with enough of a leverage into more property, and then eventually enough income and assets so that you can probably go and buy that little cottage up in the Blue Mountains just because you want to, rather than because you think it's such a fabulous investment. That's all we have time for this week. Now, next week, I'm joined by Rich Harvey from Property Buyers and also Andrew Wilson from Australian Property Monitors. So it will be a great week for getting all that area research data. Now, thank you to my guests this week, Ben Kingsley from Empower Wealth and Paul Rickard from Switzer. I think you'll agree they've done an absolutely amazing job tonight. And, of course, I'm going to be only too pleased to have them both back on again later in the first half of the year. Thanks also to our callers. Now, this week, the question of the week goes to Brett from Deniliquin. Brett, you asked about buying in Toowoomba, and I think it would be a great idea for you to know a little bit more about investing in property before you go out and choose an area in which to buy. So if you could now email me on yourmoneyyourcall@destiny.com.au, which you can see up there on your screen, I will send you your free book. But that's only for our question of the week, so please, everyone else, don't email me and ask me to be sending you the book. If you want to buy the book, of course you can from my online store or even from any good bookstore. Coming up at Destiny, your chance to start the year off the right way by joining an essential property education course, January the 15th in Brisbane, January the 28th in Adelaide, and also online. Now, you can find out more from my website, destiny.com.au. You can follow me on Twitter, Margaret Lomas AU, and now I'm also on Instagram and desperate for followers. And this weekend, the summer series of Property Success Season 5 continues here on Sky News Business. You can watch that all day from 12:30 p.m. Thanks for being with us. I'll see you next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.